All right, let's talk about money. When it comes to our finances, it feels like we're in this constant tug of war, doesn't it? On one side, you've got your gut feelings, your human instincts. And on the other, well, that's where the cold, hard systems and disciplined rules come in. So in this explainer, we're going to dive deep into the psychology of our financial decisions and try to figure out which one should really be in charge.
So let's start with a big one, a question I'm pretty sure we've all asked ourselves at some point. Picture this, you're checking your portfolio and there it is, that one investment that's just deep in the red. Your gut, your instinct is screaming, just wait, it'll come back. But why do we do that? Why is it so unbelievably hard to just cut our losses and move on, even when every logical part of our brain is telling us it's the right move?
Well, it turns out that feeling isn't just some personal quirk of yours. Nope, it's actually a super well-documented psychological phenomenon. So let's get into what the experts call the holding on problem and uncover the powerful bias that's really pulling the strings behind the scenes.
Okay, so this thing has a name. The formal term for this bias is the disposition effect. And what is it exactly? It's that weird, almost magnetic pull to sell our winning investments way too early for just a small profit, while at the same time, we stubbornly hold on to our losers just hoping for some kind of miracle. And let me tell you, it is one of the most common and most costly traps any investor can fall into.
And this really lays out the dilemma perfectly, right? Imagine you have two companies. Company A is a winner, its value is up. Company B, not so much. It's a loser, its value is down. The disposition effect is that little voice in your head that pushes you to sell Company A just to feel that thrill of a win, to lock it in. But it also tells you to cling to Company B for dear life, mostly to avoid the pain of admitting you made a mistake.
So, at the end of the day, the crucial thing to understand here is that this isn't about logic. Not at all. It's pure, raw emotion. Psychologists have a term for it, loss aversion. And get this, studies have actually shown that the pain of a loss feels about twice as strong as the pleasure of an equivalent gain. I mean, think about it for a second. Losing $100 stings way, way more than finding $100 feels good, right? It's that powerful imbalance that makes us do totally irrational things, like holding on to an investment that's clearly sinking.
Okay, so if our emotions can lead us so far astray, what's the alternative? I mean, there has to be another way, right? Well, that brings us to our next section, the math of choice. We're going to shift gears now, moving away from the psychology of the problem and into a much more rational framework for making these big financial decisions.
And the academic world, they have an answer for this. It's a concept called utility theory. Basically, instead of making your decisions based on fear or hope, it gives you a mathematical framework to find that perfect sweet spot between risk and reward, but in a really structured, logical way.
And this breaks down the core ideas really nicely. First off, it's all about personal satisfaction, what they call utility, not just the dollar signs. The goal isn't just to get rich, it's about getting rich in a way that actually lets you sleep at night. Second, it forces you to face the fact that the future isn't some straight line. No, it's more like a bunch of branching paths with a ton of uncertainty. And third, it's all about finding that balance, right? Balancing that potential rocket ship return with the very real risk of a crash landing. It's about making the math fit your personal goals.
Now here's a really powerful takeaway from all this math. Uncertainty is your biggest enemy. It sounds a little counterintuitive, but the longer your investment timeline is, the more unpredictable the future actually becomes. So, what does the theory suggest? That the size of your bets should actually get smaller over time. Why? To protect you from all those unknowns that are bound to pop up.
All right, so theory is great and all, but how does this stuff actually look in the real world? Let's make that shift now, from the abstract math to a really concrete trading system that puts these disciplined, emotion-free rules into practice.
So let me introduce you to the R3 strategy. It's a system designed specifically for ETFs. Exchange-traded funds, which are basically just baskets of different stocks. And its goal is super simple. Identify a strong upward trend, wait for a quick little dip, and then jump in to ride that next wave up. The key here, no gut feelings allowed. It's all about the rules. Okay, so here are the 3 entry rules, and this is exactly where the system goes to battle with our emotional biases. Rule number 1, the ETF has to be above its 200-day moving average. That's just a simple way of making sure the long-term trend is pointing up. Rules 2 and 3 get a little more specific. The system looks for an extreme short-term pullback using this momentum gauge called the RSI. When that RSI gets super low, it's called oversold. And I want you to think of it like a rubber band that's been stretched way, way too far and is just ready to snap back. This system forces you to buy when things feel scary, which is the exact opposite of our emotional urge to only buy stuff that's already skyrocketing.
In the exit rule, it's just as systematic. And this is what solves the other half of that disposition effect problem. When that same momentum indicator, the RSI, closes above 70, it signals an overbought condition. That just means the price has probably gone up too far too fast. So this rule forces you to sell based on data, not on your feelings. It stops you from cutting a winner short just to lock in a small gain because you're feeling anxious. Here, the system, not your fear, decides when the ride is over.
So what's the whole point of this strategy? Look, the R3 isn't designed to help you catch those massive home runs. It's built to systematically capture these short-term momentum trends, and it's specifically targeting moves in that 5 to 7% range. It's all about hitting consistent singles and doubles, not swinging for the fences every single time.
All right, so we've looked at our emotional human brain, we've looked at a logical, mathematical framework, and we've looked at a rigid, rules-based system. Now let's put them all side by side and really see the complete picture. This table really just brings it all together, doesn't it? On one hand, you've got the disposition effect. That's driven by emotion and loss aversion, and its whole objective is just to avoid the pain of realizing a loss. Then you have utility theory. That's all about mathematics and logic, and its goal is to mathematically optimize your risk and reward. And finally, the R3 strategy. It's driven by predefined rules, and it's built to systematically capture momentum. I mean, you've got three totally different approaches to the very same problem. And all of this brings us to the final and maybe the most crucial question. Look, we can't just eliminate our humanity, right? Our emotions are part of who we are. But we've also just seen the incredible power of a good system. So the real challenge then isn't about choosing one over the other. It's about figuring out, in our own decisions, where should the human end and where should the system begin.